Hello everybody and welcome. Thank you for joining today's webinar, part of the UK Outlook series, UK Tax Updates during COVID-19. My name is Helen Starr and I am the Head of Events at the British Chamber of Commerce in Singapore. I'm delighted to be joined today by Martin Rimmer, the Head of Tax at Select Investors, and Mark Addy, the Director of International Tax at KPMG, as they discuss the UK tax implications of the recent spring budget and COVID-19 for businesses and internationals with UK ties. I would also like to thank our event partners today, Select Investors, who are long-term supporters of the British Chamber of Commerce in Singapore. Select Investors provides first-class holistic tax, wealth and succession advice, which is tailored for British, Australian and Singaporean clients. They aim to be the most respected and trusted wealth management practice in Singapore, engaging, inspiring and delighting their clients. Their approach is focused upon delivering what you need and helping to make informed financial decisions to achieve your goals through personal, face-to-face, tax-efficient financial advice. So thank you very much to Select Investors. Today, we will also be taking questions at the end of the session. So at the bottom of your screen, you will see the Q&A function. If you'd like to submit any questions in there, Martin and Mark will address those at the end of the session. We're looking to talk to you today for around an hour, finishing at about 5 o'clock. And the recording will be available after this event in around 2 weeks' time if you'd like to refresh your memories on anything discussed today. So with that, I'll hand over to Martin. Thank you very much for joining us and I shall see you soon.
Thank you very much indeed, Helen, and a very warm welcome to you all today. These are odd times, aren't they, with a lot of us working from home, and it seems an astonishingly long amount of time since the last budget, which is obviously what we'll be talking about today. But whether you're joining us from Singapore, Hong Kong, or indeed the UK, you're very welcome indeed. The title of today's webinar is the Spring Budget 2020 and obviously the government's response to COVID-19. It feels perhaps a little bit gratuitous to be talking about a spring budget because so many more important things have happened in the interim. That said, there were some fairly important announcements and we felt just taking a respectful pause to allow COVID and the response to that to filter through, just to readdress this issue, and I'm absolutely delighted today to be joined by my very good friend, Mr. Mark Addy, said Director of International Tax at KPMG. Mark, thank you for joining us today, much appreciated. How are you?
Very well, thank you, Martin.
Great. So we should have a fun-packed afternoon of tax and COVID response information. And just to reiterate what Helen was saying, we would, of course, be delighted to take your Q&A towards the end of the slide. Just before we get going, a brief disclaimer that we are required to share with you today. All that basically says is please talk to us personally. We're a firm, both KPMG and St James's Place, a firm that specialises in providing face-to-face advice that is tailored to your individual situation. So if there are any things that we talk about today that you think, well, how does that impact me? Do please talk to us. We'd be delighted to give you the answers. So our agenda today really falls into three main areas. So the main budget announcements, and I'll be talking through the personal tax side of things. There are some fairly important things in there. And then Mark will be talking about business tax and then the coronavirus response from a business perspective. He will then be handing over to me just to talk through just a couple of slides on the UK government's response for private individuals and the self-employed, before we then focus on just a couple of specific tax effects. So I'll spend a couple of slides talking about the statutory residence test and the impact for people who were detained in the UK. And Mark will come in with some closing thoughts on the question of corporate residence and how that's been affected by the by COVID-19. So without further ado, these are the main protagonists. Now, these are probably names that you're familiar with by now. Obviously, Boris Johnson there, bottom right. In the run-up to the March 11th budget, he said this: it is a time to be bold. We have to have courage. We're going to support jobs and support business. We will do, in short, whatever it takes. And he was saying that in connection to COVID-19. And the government has indeed unfurled a huge raft of measures. And whatever side you take politically, personally, I find that the response has been pretty impressive. The chap top left is Mr. Rishi Sunak, who was elevated to the position of Chancellor just before, or just after the general election, and I don't think it's an understatement to say that we've never in peacetime faced an economic fight like this one. What was expected to be a fairly short-term Q2, Q3 type of an impact looks like it's going to take a little bit longer than that to settle down. So never have we needed a competent Chancellor more than we have at the moment. First and foremost, when Rishi Sunak stood up to deliver his first budget speech, he spent the first 15 minutes talking about what they immediately wanted to do as far as COVID-19 was concerned. Now, you may remember that just before he stood up on Budget Day on the 11th of March, the Bank of England dropped their base rate from 0.75 to 0.25. And that was really very much in line with the budget announcements, in support of the budget announcements that were then going to be made. And again, that dropped further to the historically low level of 0.1% just a few days later. And hopefully for those of us who are on tracker mortgages, we've been seeing the benefit of that. Very much an aspiration, as you know, to provide whatever the National Health Service needed to cope with coronavirus, and as we'll see in a moment, they plugged really quite a lot of additional money into that. 5 billion, in fact, was announced on Budget Day, and that has since been topped up. In terms of immediate measures for the employed, anyone who had to go into self-isolation from day one, the government started to cover the cost of statutory sick pay rather than the employer, and they'd be doing that for 14 days. And again, I'm sure that's going to be extended. They have done quite a lot as well to ease the burden for the payment of tax. So for those of us who are paying income tax in the UK and capital gains tax, and we have a payment on account system, a second payment on account in respect of the 2021 tax year is actually due by the 31st of July, but they pushed that a full 6 months further on. So if you normally pay your tax in 2 instalments, the second instalment on the 31st of July is now going to be due no later than the 31st of January 2021 with no additional interest. They've obviously, the lockdown has hit many businesses, and they were very keen indeed to make some immediate announcements about retail businesses that they felt were going to be immediately hit. So for businesses in the hospitality sector, they've obviously given a business rates reduction for the full tax year where the rateable value is less than 51,000, and then a grant for the majority of others. In addition to which, and Mark will be talking about this a little bit later, the Coronavirus Business Interruption Loan Scheme, which has made almost £1/3 of £1 trillion worth of loan capital available for businesses of all shapes and sizes. So they were announcements made on the 11th of March, and that's been overtaken quite substantially since, as we'll be coming to in a moment. Just a couple of other major spending announcements, which I thought would be worthwhile touching on. There is obviously that initial £5 billion emergency response fund for the NHS to deal with COVID-19, but they have also in addition promised an extra £6 billion over the course of the Parliament to the NHS, taking that 5-year spend to £40 billion, which I'm not sure whether that's a historically largest level, but it's certainly a significant amount of money. The government's also very aware of the need to promote export, so they've devoted another £5 billion of new export loans for businesses, so that's obviously going to be of interest to anyone looking to do business outside of the UK. I thought the next one was very interesting as well, and Mark will be touching on R&D credits when we come to business tax review, but there will be an extra £4 billion of investment into R&D, taking it up to £22 billion a year. That is, would you believe, more than China spends on R&D It's not more than Germany or the US spend, but still it's a very, very significant commitment. And I think without wanting to be in any way party political here, it just shows the commitment of the government, I think, to promoting research and development in the UK and really making UK a technology and a science hub. And then just near the bottom, then obviously a fairly significant investment into our roads infrastructure and a dedicated 2.5 billion to fill apparently 50 million potholes, which would be great. I don't know how long that's going to take them to do. It certainly won't happen in a year with all the lockdowns, but I thought it was amusing they've actually allocated some money specifically to that. Now, getting on to the main income tax announcements. Fairly light. The main tax rates have remained unchanged. The income tax allowance is 12,500 as it was. Tax rates, bands and allowances have remained exactly as they were. What they have done, however, is for children who live in the UK, it's possible to make ISA contributions, individual savings accounts. Previously that was at about £4,500 a year. That's now gone up to £9,000 a year. So for those of you who are not aware, an ISA is an investment vehicle into which you can invest the very, very broad range of things that you can invest through there, but the income and the gains generated by those investments are completely free of tax. The government has added 50% to the flat rate home working deduction, which is of course relevant with so many people working at home now. So for those who are in the UK, whether or not you're resident, if you're working in the UK, you're actually able to claim that. So £6 a week doesn't sound a lot, but it actually does amount to an additional 50% on the possible deduction previously. They've also decided to adjust the pension lifetime allowance up to £1.73 million. So what is the lifetime allowance? The lifetime allowance is the amount of money that you are allowed to have in UK approved pension schemes without triggering a charge to tax when you crystallise those benefits. So that many years ago used to be 1.8 million, it came all the way back down to a million, and now they've committed to increasing it in line with inflation. Also, a few years ago, they introduced a tapering back of the amount that you can contribute to a UK pension scheme where your income exceeded a certain level, and that level was £150,000, and then you gradually got to taper back from a maximum of £40,000 you could contribute on a tax relief basis down to 10. They've actually just increased that £150,000 threshold by £90,000 to go all the way up to 240, and that's very, very welcome indeed. That just allows people to make higher tax relief contributions to UK pension schemes. Mark will be talking briefly about off-payroll rules, which can impact some non-residents as well. That's been delayed, but he'll be coming on to that later. And I also just wanted to highlight something that I've spotted in the law. I don't think it's terribly well known, and it is something that we're looking at lobbying the government on. But the entitlement that we have as British nationals to the UK personal allowance of £12,500 is anchored in law in what we call Section 56 of the Income Tax Act 2007. Now that basically says that we as British nationals are entitled to that allowance as a non-resident only by virtue of being nationals of a European Economic Area country. So not because we're British, but because we're nationals of a European Economic Area country. We have now, of course, affected Brexit, so the UK is no longer a member of either the EU or the EEA, but the transition agreement allows for the continuation of deemed membership until the end of December this year, which in turn gives us a full allowance for this year. What's the point of saying all of that? Simply this, that the government needs to do something. They need to legislate to protect personal allowances for non-UK resident British nationals. They are aware of the issue and they plan to make an announcement towards the end of the year. For my part, I will, of course, be lobbying that they make the change that we all want, but I think forewarned is forearmed in that respect. So that was really all there was on income tax. Just a couple of things on capital gains tax. In the UK, the annual exemption has gone up from £12,000 to £12,300. So that's the amount of capital gain that you can enjoy without having to pay tax on. For those of us who are non-resident, that really only pertains to gains made from the sale, the gift, or the assignment of interests in UK land and property, but we do get that allowance. The government's also resisted the urge to abolish entrepreneurs' relief, but it has taken the lifetime allowance down from £10 million to £1 million. And for those of you who aren't aware of this, entrepreneurs' relief is a capital gains tax relief that allows you a beneficial rate of 10% on gains derived from the sale and the transaction of interests in your own companies. So owner-managed businesses and the like. They've done some number crunching and realised that only 5,000 people were benefiting and they were taking the majority of the relief. So they brought that lifetime allowance down to 1 million. But interestingly, have left its sister relief, investors' relief, untouched. And investors' relief is simply a relief that will allow you to enjoy a 10% rate of capital gains tax on the first £10 million from the sale of interest in private businesses which are not yours, in which you do not work. So really aimed at angel investments. So clearly they're keen to continue to promote that. A couple of things that have come into effect on the 6th of April 2020. They weren't in the budget, but they were due to come in respect of the sale of homes in the UK that you used to live in. You used to be able to get the last 18 months worth of gain completely free of capital gains tax. That's now been reduced to 9 months. And where you let out a former main home, you also were able to get a certain amount of relief from the gain during the letting period. But again, that's now been completely curtailed. Really just for your own information, if you are looking at transacting interests in UK land and property, it is now necessary to file, it's been necessary for a little while, to file a non-resident capital gains tax within 30 days of the transaction. But what has changed is that the tax now also needs to be paid within that same 30-day period. So the gift, the sale, or the assignment of interests in UK land and property assets of any sort do need to be reported. And if you need any help with that, of course, do let us know. We do lots of tax compliance for clients. Now, probably the main announcement that really impacts us non-residents, the government has announced its intention to apply a 2% surcharge on all the main rates of stamp duty land tax for completions of residential property with effect from the 1st of April 2021. Just England and Northern Ireland at this point. Stamp duty land tax only governs England and Northern Ireland. In Scotland, we've got something called land and buildings transaction tax, and in Wales we've got land transaction tax, and we've not had announcements from either the Scottish or the Welsh revenue authorities about mirror arrangements. So I'm sure that will come, but unfortunately we do have to reckon with this surcharge. So if you are looking at buying UK property, it is going to be a bit cheaper for you to do so, provided you complete before the 31st of March 2021. There was a consultation on this a couple of years ago. They haven't yet revived it. We'll have to see whether they do, but I'm expecting them to legislate on a slightly different definition of non-resident for the purposes of knowing whether or not this surcharge applies. If you happen to have exchanged on a property pre-budget date, actually it should read the 11th of March there, and it's not scheduled for completion until after the 1st of April, I do expect the government to allow you to still pay under the old rules. Now, the silver lining, if there is one on this, is that the money is ring-fenced. What they're hoping to raise is going to be ring-fenced to tackle rough sleeping, so a very worthwhile cause indeed. So these are the stamp duty land tax rates as they currently stand. There's a standard set of rates if you're replacing your main home within a certain period, or if the property you're buying is the very first one that you, your spouse, or your children under the age of 18 have got anywhere in the world. And for every other situation, it's those accelerated rates. And so for completions with effect from the 1st of April 21, we're just going to be seeing these rates. Obviously, it changes the dynamic somewhat on the purchase of UK property for purposes other than use as a main home. It's just another cost to bear in mind. And needless to say, we're very happy to advise on overall costs of purchase of property, rental tax costs, capital gains tax costs, and the like. Just a couple of other minor things to say before I hand over to Mark to cover the corporation business tax aspects. Namely, this is very, very long overdue, to be honest with you. Would you believe that the provision of UK tax advice and the preparation of UK tax returns in the UK is completely unregulated? You don't even have to be a member of a professional body to do this. So finally, the government has decided that it wants to raise the standards, which I think has to end up in some kind of regulation, perhaps in concert with the Chartered Institute of Taxation or the Association of Taxation Technicians, and probably also the Institute of Chartered Accountants of England and Wales. This is fundamentally a brilliant thing. It's going to protect people who take advice, and it's also going to make sure that the providers of those advice are fully qualified. So it's a really very good thing. Anything that enhances regulation is a good thing. So I'm going to ask Mark this question. I've asked you this before, haven't I, Mark, when we did this last time, but do you have any idea from a personal tax perspective what peat bogs, the A303, Grey's Anatomy and potholes have in common? Cue the answer.
I think I've forgotten the answer, actually, Martin. I'm going to have to defer back to you for that one.
Very well scripted. Well, thank you. The peat bogs, the A303, Grey's Anatomy, and potholes were all mentioned once in the budget. Would you believe they're actually going to allocate some money to peat bog investment? Would you believe? And Grey's Anatomy was something to do with VAT on educational publications. They were all mentioned once. Inheritance tax was not mentioned at all. An astonishing admission, possibly a casualty in the budget of COVID, possibly. The Office of Tax Simplification has published lots of recommendations about a radical overhaul of the inheritance tax law. We were expecting some announcements on that in the budget. What I think we will find is that there'll be something in the autumn budget, but I found it astonishing that the words inheritance tax didn't pass Rishi Sunak's lips even once. So they're the main announcements from a personal tax point of view. Mark, I'll hand over to you now just to cover some of the aspects from a corporation business tax, as well as the government's business response to COVID-19. Thank you.
Thank you, Martin. So as Martin said, what I'm going to cover here is the main implications for business arising from the original budget on the 12th of March, or the 11th of March, which I think feels like a distant memory to many. We'll then have a look at some of the international tax issues that arise or have arisen due to travel restrictions imposed on certain individuals as a result of COVID. And then we'll have a look at some of the financial aid available for businesses to try and help them through this pandemic. So in terms of the main changes from a business tax perspective, the first notable announcement was in relation to the corporate tax rate, which will remain at 19%. Now, this doesn't sound like a major update, but it is worth noting in this respect that the previous Conservative government had intended to decrease the rate to 17%. Now, this has been scrapped by the current government, and I think is probably an area that needs to be watched closely, particularly ahead of the autumn budget, as the government needs to raise additional funds to offset some of the increased spending throughout the COVID pandemic. The second noteworthy announcement is the research and development expenditure credit, which will increase from 12% to 13%, and this ties back to the government's significant commitment to, I think it was $20 to $25 billion pounds of additional funding on R&D up to 2025. So this roughly equates to about a £10 cash credit for every £100 of expenditure on research and development. So it's quite a significant incentive for companies to carry out that activity in the UK. And then the third rate change worth mentioning is in relation to structures and buildings allowances. So this is a small boost for the construction industry, which has obviously been hit very hard throughout the COVID crisis. They will be able to take allowances for expenditure incurred on structures and buildings at a slightly quicker rate than they previously could. So it's increased from 2% to 3%. I think probably the most significant announcement from a business tax perspective in this budget was the confirmation that there will be a 2% digital services tax that is now effective from April 2020. Now, interestingly, this wasn't part of Rishi Sunak's main budget speech. It was hidden away in the annexes. And that's quite possibly because this is considered a slightly controversial tax. So this is a tax that will apply on gross revenues of very targeted businesses. So if you look at the types of businesses that this applies to, social media platforms, search engines, and online marketplaces, there's a perception from a US perspective, and we've seen Trump come out when the French tried to implement a similar tax and threaten excessive tariffs on things like wine and cheese being exported from France into the US. He sees this as an attack on large US tech businesses, and it's easy to see why when you look at the businesses that this applies to. So this was kind of hidden away. It didn't get a lot of publicity. It may be a short-lived tax. The UK has said that they will implement any consensus decision from the OECD. So the OECD is working on a separate way in which they can tax digital businesses. If a consensus is arrived at, then the UK has said that they will adopt that. But they have slightly jumped the gun by implementing this tax effective from 1st of April. And also, I guess this is a timely tax, and in some ways fortuitous that this was implemented just before significant increased spending was announced in the 3 subsequent budgets within about 9 days of the original one. So it will go some way to offsetting that increased expenditure. Whether or not there will be a ripple effect and some backlash from the US remains to be seen. Couple of other relevant updates from a business perspective. So there will be a plastics packaging tax of £200 per tonne, which will apply from April 2022. And this is aligned with the government's encouragement of businesses to avoid plastic packaging wherever possible. So there's a little bit of time before you start to be impacted by that tax. And then another major announcement was in relation to IR35 changes, which Martin alluded to in his comments earlier. And this will be delayed until 2021. Now, IR35, for those that are not aware, is a piece of legislation which effectively kicks in when a contractor is acting through an intermediary company, but is effectively, if you were to lift that corporate veil, an employee of the company. By acting through that intermediary company, they're gaining both income tax and national insurance benefits. And prior to these changes, the burden of assessment and liability fell on the individual. That's now shifting to companies. So companies will be required to assess all of their contractor arrangements to determine whether they are caught by this piece of legislation. And like I said, the intention was to implement that effective from April 2020. Lots of businesses have already made changes to their IR35 arrangements. They changed contractors into employees. And I think this would have gone ahead but for the COVID situation. So it's now been delayed until 2021, which gives businesses a little bit more time to do that assessment and make sure that they're not caught by any of these changes. So they were the main business tax updates from the original 11th March budget. And I think it's fair to say that it was a fairly light budget from a business and corporate perspective. And in the current circumstances, I guess that's probably not a bad thing. What we're now going to have a quick look at is international corporate tax issues that have arisen due to temporary travel restrictions as a result of the COVID-19 pandemic. The first one of these relates to corporate residents. So to take a very basic example, if we had a Singapore company which for any reason has got key management or key directors that are stuck in the UK for a period of time, it may be that impacts on their corporate residence. Corporate residence is generally determined by where the central management and control of a company is exercised. Now, if those individuals cannot exercise that management and control while they are in Singapore, and they're actually doing it while they're in the UK, theoretically that can impact the Singapore company's resident status, and it may be deemed to be a UK tax resident. The effect of that is that it is brought into the UK tax net and potentially has to pay UK tax on its profits. Now, HMRC have made an announcement in this respect. They believe that their current residence rules provide sufficient flexibility such that the residence status of companies will not be affected by these temporary travel restrictions. They've said that they consider a whole range of factors, and that the temporary location of senior management, directors, or even board meetings taking place in the UK of say a Singapore company or a company in another jurisdiction should not be sufficient to change the residence of that company. Now that gives some comfort to companies. It is still an area that you would want to be careful of, to make sure that, you know, the longer these travel restrictions go on for, the greater the risk is that it affects your tax resident status. Similarly, on the same theme is that of permanent establishment. This is a slightly different concept to residence, and is a concept whereby a non-resident UK company or a non-incorporated UK company is deemed to have some kind of taxable presence in the UK, and that's normally by employees or representatives of the foreign company undertaking activities while they are in the UK. There are tax treaties in place which deal with this. And again, HMRC has announced that they will take a sympathetic approach to this, but their position is not 100% clear. And I think they quite often have referred to employees being located in the UK for a quote-unquote short time. Now, what we are seeing is that these travel restrictions are extending over a much longer period than was originally anticipated. So I think the longer that goes on, it's an area that you need to be particularly careful of and particularly mindful of, to make sure you're not inadvertently creating a taxable presence in other jurisdictions outside the normal jurisdiction in which your employees are based. There is some additional comfort that's been provided by the OECD, who have basically said that any PE or residence issues created by temporary travel restrictions should not create a permanent establishment or change your tax residence status. So they've gone a step further than HMRC. I think where there are tax treaties in place, we would expect HMRC to follow the OECD's guidance on that. But certainly an issue that we want to be mindful of as the travel restrictions are extended further. So they were the main international tax related updates and impacts of COVID-19. What we're now going to look at is some of the financial aid that's been made available for businesses, and this has generally been in some of the subsequent budgets that Rishi Sunak has announced on top of the 11th March budget. So there are two broad loan schemes available. One is available for smaller businesses, one is for larger businesses. And for small businesses, it's businesses with up to £45 million of turnover. They can borrow up to £5 million. And the main benefit here for businesses is the government will provide an 80% guarantee and will cover interest in the first 12 months. So this makes it much easier or much more palatable for financial institutions to lend to companies, given that the loan is 80% guaranteed by the government and they know that the interest is covered for the first year. On a last check, there are about 40 accredited lenders for this scheme for smaller businesses. The government is opening this up to alternative finance lenders to increase the number of potential lenders under this scheme. The second and interlinked with this is the large business interruption loan scheme. This is for businesses with turnover of greater than £45 million, and they can borrow up to £200 million. There are, where you borrow over £50 million, restrictions on dividends, pay for senior executives, particularly where you want to make cash bonuses. They will be restricted for the time that you have that loan outstanding, and you won't be able to make any share buybacks while that loan is outstanding either. But the same 80% guarantee applies for the large business scheme as well. And I think Martin mentioned earlier that something like £1/3 of a trillion has already been borrowed under this scheme. So it's proving very popular and absolutely necessary to help both small and large businesses through this situation. On a similar theme, there is also a corporate finance facility which has been announced. The idea of this is that it provides large businesses with access to short-term corporate debt. There are lots of conditions that attach to this, and one of the most interesting ones is that the company must be making a material contribution to the UK economy. Now, that interpretation is obviously wide open, but it does suggest that if you have been actively trying to avoid tax in previous years, that it will be more difficult for you to access this scheme. And I think there's a high profile example of that currently in the press. In the first 10 days of this scheme, 1.9 billion of debt was issued. So it's clearly proven very popular. And I think an additional 1.6 billion has been committed subsequent to that. So again, it really demonstrates the need for financing in this period. There are also some other measures, just to demonstrate that nobody's been left out from these measures. There is a bounce back loan scheme for small businesses. An idea of this is it gives small businesses access to funding within 24 hours, and they can access up to £50,000 for short-term cash needs. There is a 100% government guarantee for this scheme, and they've also agreed a low interest rate with the banks on the basis that there is this 100% guarantee in place. There is a future fund available for high growth companies, which will comprise both public and private financing. In this case, it is basically to encourage private financiers to continue to invest in high growth startups and high growth companies by giving them some comfort that the government is also willing to match their investment up to £5 million. These instruments do come with conversion options, so if a company is unable to repay that financing within a certain period, they do automatically convert into equity. But it gives companies that wouldn't normally be able to get bank borrowing access to additional financing in this period. There is some additional support that's been made available to SMEs that are focused on research and development. And again, this ties in with the overall theme of supporting research and development activity in the UK. So there's an additional 550 million available in grants and loans, which will be administered by Innovate UK. And then back to tax, there's also the option to defer your VAT payments between March and June of this year to the 31st March 2021. And also a mechanism to defer corporate tax payments if you can demonstrate that you haven't got sufficient cash to make those payments or the instalment payments as they arise. So a number of measures to try and assist businesses through this period. It does look like the economy is starting to open up again slowly in the UK. So hopefully there won't be a significant extension or a requirement to significantly extend some of these measures. But I guess only time will tell in that respect. I think that's everything on the business tax updates. I'll hand back to Martin, who's going to talk briefly through some of the additional government responses and the statutory residence test.
Lovely. Thank you ever so much indeed, Mark. Really helpful, really insightful as ever. I've just got a few slides really just to cover the government's response in respect to private individuals and the self-employed. I won't talk through every single one. It's needless to say that we're very, very happy indeed to make the slides available. First thing, if you do have a personal tax debt and you're struggling to pay it because of the impact of COVID-19, they are very happy to talk about how to help you manage that. These are extenuating circumstances, and the number is right there. There's also a resource available for whether you're private individuals, self-employed business owners, to find the right tailored resource for yourselves. Now, you will all have heard about the furloughing of staff. In the UK, that's really, people have really gone to town on that. So in effect, the government's agreed to pay up to £2,500 per month, including associated employer national insurance and employer pension contributions for the period to the 30th of June, up to a maximum of 80% of salary or £2,500 a month, whichever is lower. And really the aim of that is to stop employers from laying people off. So there must be a guarantee of work, guarantee of the continuation of employment, and during that time, needless to say, those staff cannot actually work, so they can't take money off the government and then continue to have them working. I thought it was worth just mentioning there that if there are people who have passed away from COVID-19 who have actually been frontline health, there is a one-time payment from the government in respect of that. The bottom one is worth a mention as well. A guaranteed 3-month mortgage holiday where you are in difficulty paying your mortgage because it's a mortgage on your main home, you're just having difficulty, or where it's a property that's rented, your rent has been unable to be collected, or your tenant's in difficulty. So, and that would not impact your credit rating at all. That is open, obviously, where there are UK mortgage arrangements in place. So it doesn't preclude a non-resident from requesting that holiday from lenders. And I think all major lenders have been required to participate in that scheme. Allied to that, the government has made it clear that if tenants are having difficulties paying, you can't turf them out within a relevant period, however long that national emergency lasts for. I also briefly mentioned that the government earlier that the government has extended the deadline for paying the second payment on account in respect of the current tax year from the 31st of July to the 31st of January on a no interest charged basis. You don't need to be in financial difficulty to do that, though. So in essence, that is something that you can go ahead and deal with. And as Mark mentioned before, just at the bottom there, the Q2 VAT payments again don't need to be paid until the end of the current year. I'm expecting the majority of viewers are not self-employed in the UK, so I won't mention that penultimate point. They're the main points. There are one or two others, but what I also wanted to address now was the impact of COVID-19 upon the statutory residence test. And as I'm sure many of you will be familiar with, the statutory residence is a body of law that basically provides for a number of tests that gives you a guaranteed outcome as to whether or not you're non-resident or resident in a given tax year. Now, the outcome is obviously only as good as the information used to get to that outcome, but it is a clear procedure that gives a clear outcome. But obviously what we have found is that a good number of people who are aiming to continue to be non-residents have found themselves in self-isolation in the UK. So naturally, the question arises as, is this going to impact my ability to stay non-resident? Well, there is some good news, namely that within the law, we do have this concept of exceptional circumstances. So if you are in the UK and are unable to leave due to circumstances beyond your control, then the government will effectively allow you to exempt up to 60 midnights of physical presence in the UK whilst those exceptional circumstances continue to be in place. Now, typically, this is there's no very formal bit of law about what does and doesn't count as exceptional, but the government would typically accept that things like having some kind of accident in the UK that prevents you from leaving, or a number of years ago there was an Icelandic volcano that decided to blow up and all the flights were cancelled, and that was exceptional. Well, the government has announced that, let me just put all this on here, that COVID-19 does obviously amount to an exceptional circumstance. But I just wanted to, I've actually reproduced the law here. Don't worry about point 4. Point 5 is the interesting point. Example of circumstances that may be exceptional are national and local emergencies, so on and so forth, or sudden and life-threatening illnesses. Now, they have said that if you are detained in the UK in self-isolation, are unable to leave because because there's no reasonable way out, or there's some kind of government advisory in place that prevents you from leaving, they will allow you to exempt those midnights from the count. And it's 60 midnights per tax year. So the clients that I've got who are impacted by this went into self-isolation in the UK, or enforced isolation, at the end of the last tax year, and they're still in it now. So there's 2 allocations of 60 midnights. But it's vitally important to qualify for this. There's two main conditions. Number one, apart from the circumstances qualifying, it's very important you didn't come to the UK in anticipation of being locked down. You didn't make the choice to be locked down in the UK. I don't know of anyone who's done that. But the other vitally important one is that you must leave the UK as soon as you reasonably can. The law doesn't define that. As you can see, it's point 4b there. You've got to leave the UK as soon as those circumstances permit. In other words, when it's safe to do so and you can, where you can jump on an aeroplane. So do just bear that in mind. If you don't leave as soon as those circumstances reasonably permit, there is a chance that your claim for 60 midnights per tax year extra, or up to 60 midnights, would be disallowed. A couple of other points to make on this. As I say, what constitutes exceptional circumstances have been extended, as I said, because of COVID-19. And I've lifted this directly from the government's announcement. So if you're quarantined or advised by a health professional to self-isolate as a consequence of the virus, or if you know, official government advice is not to travel, or if you can't leave because the borders are controlled, or indeed if your employer has said you've got to go back to the UK as a consequence of this, that all counts. So I'm delighted that the government has given that that certainty, and know that they'll be writing that into the law soonest. Just worth pointing out that this 60 midnight exemption covers direct counts of midnight. So, you know, the statutory residence test consists of various tests, most of which require a count of midnights. And if you're within the relevant count, you're non-resident. If you've exceeded it, you're resident. And so the 60 midnights qualifies as deductible for the purposes of those top line calculations. But there are certain areas within the statutory residence where having extra time in the UK does count towards ties. So, for example, there is an only home in the world in the UK test, which requires you, if you meet this condition, if you spent 30 days in the UK in a particular property and you have no other property anywhere in the world, well, the fact you get 60 midnights exempt doesn't change the fact that you might qualify as having your only home in the world in the UK. And similarly for the full-time work in the UK test. There are one or two parts of what we call the sufficient ties test that are not impacted by the 60 midnight exemption. So, for example, one of the tests is, have you spent at least 90 more midnights in the UK in either of the 2 previous tax years? Whether you have done, the reasons for that are immaterial. So, you know, you do hit your 91st midnight, and that's partly because of COVID, where you don't get to the exemption under that circumstance for that part of the test. And equally in accommodation time in the UK, if there's a property, or if you spend at least 16 midnights in the home of a close relative during the year, and it wouldn't have been 16 but for the fact that you were detained because of COVID, well, sorry, you do then have an accommodation tie. So for both the 2019-20 and 2020/21 tax years, we do need to pay a little bit of attention to the statutory residence test, you know, particularly if you need to complete an annual tax return. I have a 4-page write-up on that, which I would be very happy to supply to anyone who requests a copy. So they're the main points I think that we wanted to make today. And really, it's then just on to questions and answers. And I wanted to start by bringing yourself back in, if you don't mind, Mark. And I wanted to just ask you whether you think, as a consequence of all that's going on with COVID now, we're likely to be seeing any increases in corporation tax in the forthcoming budget. Do you have a view on that? Is there a sort of KPMG view that you can share with us on that?
I mean, I think it would all be speculation at this stage, but certainly if we're looking ahead to the autumn budget, the corporation tax rate will be a very easy place to start in terms of increasing rates. Obviously, significant taxes are earned through corporation tax. By maintaining the rate at 19%, that there is a significant additional income that the government is expecting from not reducing it to 17%. And there have been some murmurings and rumours recently that the corporation tax may start to increase. I mean, the UK rate of 19% is already among the lowest in the G20. So I suspect that if there are tax increases in the next budget on businesses, that is certainly a place that they would look to start. I don't think it will be significant increases. It certainly won't be back to the days of 28, 30% that we used to know 15, 20 years ago. But it may start to creep up to 20% and slightly above that over the next couple of years. Just to fire that back at you, Martin, from an individual tax perspective, are there any particular areas that you think may be targeted? Non-residents, for example, further stamp duty increases or anything like that, in order to raise more revenue?
A fair question. Well, the government has committed to keeping the rates of income tax, national insurance, and capital gains tax, I believe, you know, unchanged through the Parliament. So its hands are somewhat tied there. I think, and it's hard to imagine them having another go at stamp duty, land tax. I mean, it was only it was only about 6 months ago that Boris Johnson was talking about reducing the rates. Yes, there may be a knee-jerk reaction post-COVID. I think, just coming back to a couple of points I made before, where we're most likely, I think, to see some kind of change is in inheritance tax. And whilst we don't really know what the government's position on the the badly named Office of Tax Simplification's recommendations are, they do involve the actual payment of a tax on the gift of monies over and above a certain amount. So it may very well be that they decide to adopt that. So, you know, an upfront payment of tax to gift, you don't need to survive 7 years, and then the inheritance tax due on death is much lower. There's a kind of quid pro quo, but that of course does put more money in the government's hands slightly earlier. I also think that it's going to, if I was Rishi Sunak and Boris Johnson, I'd perish the thought. I'd find it hard to resist the urge not to change that law I mentioned before about the personal allowances, you know. As much as it pains me to say so, and you know, we will be attempting to lobby hard, non-residents are an unrepresented body of you know, people who many of whom are not voters, are not eligible to vote anymore. The government did try to, well, did have a consultation document a number of years ago about removing the personal allowance under certain conditions, and they kind of need some revenue. I mean, if you work on the basis that, I mean, I don't know the exact number of Brits who are living abroad, but say it's 5 million around the world, and that they have on average £10,000 of income each, you know, from state pensions, rental incomes and stuff, and all of that suddenly gets taxed at the basic rate of 20%, that's an extra £10 billion a year. If I was the Chancellor, I'd be struggling to find the motivation not to do that. So, you know, as much as it pains me to say so, I think that might be coming down the track, but that's mostly speculation from my perspective. We have actually had a couple of questions in, so if I go straight to them, I've been asked, and perhaps there can be a dual answer on this, Mark. So Richard has asked us whether furlough payments are subject to income tax. Now, the personal tax answer to that is, well, the furlough payments are simply payments that are made to an employer to help subsidise salary costs. Those salaries, if you're a UK resident, are of course still subject to income tax and national insurance in exactly the normal way. Mark, is there anything you can add on? Perhaps, you know, would that be regarded as the receipt of you know, a taxable receipt from the government that needs to drop into corporation tax?
I would think it would be tax neutral from a corporate tax perspective, on the basis that it is ultimately going out to your employees. So there'd be no overall net tax impact from the employer's perspective. They obviously lose out on a tax deduction for employee costs that they're no longer bearing. But overall, I would think it's a net nil position from a corporate tax perspective.
Yeah. We've also been asked for capital gains tax, do we need to declare the sale of a property after 30 days as a non-resident, even if there's no tax to pay? The answer is yes and no. The no answer on that is if it's simply a transfer of an interest in property to a spouse. Don't need to declare that. There's almost certainly, well, there's never any tax to pay on that. But in every other situation, yes. And if there's no tax to pay, that's going to mean, I guess, almost by definition, that there you know, could very well be a capital loss there. And if you do have a loss, worth reporting it. I mean, you have to report it, but it's worth reporting because those losses can be carried forward and set against future gains. And as and when you go back to the UK, any accumulated losses in that respect are then converted into a type of loss that allows you to set it against any gains, not just residential and commercial property gains. We've also had an excellent question from Alison, which perhaps we can take together, Mark. And perhaps I could ask you to comment first on this one. As you've mentioned, there are rumours of increased taxes. Might it be more likely that the government would introduce a wealth tax or remove main residence relief on capital gains tax rather than focusing on taxes that will impact on lower earners, example, income tax and VAT? So we're more likely to look at wealth taxes and removal of reliefs on main residence than sort of income taxes and VAT. Do you have an initial view on that?
Yeah, I mean, I guess to address the wealth tax point first, and without wanting to be too political in my answer, I would be surprised if this government introduced a a wealth tax on the the higher bracket earners. I'd also be surprised if they increase the higher rate of income tax. I think what's more likely is to increase taxes that affect either non-resident companies or non-resident individuals. So we talked earlier about the potential for increasing corporation tax to 20% potentially. There's the possibility in all these situations that the government would look to things like transfer pricing, particularly for foreign multinationals that have operations in the UK, to really assess whether or not they are paying enough tax in the UK. The digital services tax goes some way to trying to address that for the tech companies. There's also lots of other companies that will have significant operations in the UK and derive significant revenue from UK customers, where it may be argued that they're not actually paying sufficient UK tax. So a more aggressive approach to transfer pricing might be one way that they seek to raise some more of its income. I don't think we'll see a VAT increase. There will be a lot of encouragement to increase spending following all of these measures, and once the economy starts up again, I think a VAT increase is something that would deter spending. So I think the focus areas will be probably a small increase to corporate tax, and potentially measures that impact non-residents more than residents of the UK.
Yeah, just a couple of points to add from me there, Alison. I think your point about principal private residence is well made. They have been chipping away at that over the years. It would be tremendously unpopular to remove that relief entirely. You have your only home in the world. You want to downsize, upsize, just replace it, and you get clobbered with capital gains tax at what would be probably 28% on the majority of the gain. So I think it's unlikely that they will remove private residence relief at this stage, but I think it is something that they would potentially be interested in looking at, but I think they probably look at it and then move on. Where you will begin to see, there's an ever increasing focus upon tax avoidance, aggressive tax avoidance, particularly things that use contrived structures or look for loopholes in the law or areas where the law is silent to try and eke out an artificial tax advantage. I think rightly so that the government's really clamping down on that tremendously, particularly in the corporate sector. So it's hoping to derive an enormous amount of money from that. There's what we call a tax gap. A gap between the amount of tax that's due based on government calculations of economic activity and the amount of tax that's collected. It's about 8%. Now, some of that will be legitimate planning, of course, but a chunk of that won't be. So I think we're going to see an ever-increasing focus on anti-avoidance legislation. And so just to wrap things up, Mark, given that we are almost at the hour, there was one question I had just as you were talking about the digital services tax, and you mentioned Donald Trump and this being primarily something aimed at US tech companies. Do you think it's been introduced primarily with a view to being a bargaining chip in trade negotiations? I mean, okay, we'll abolish it if you give us this concession here. Do you think that's, or is that probably not the case because the OECD wants to do something?
I mean, I think it's certainly a possibility. The UK, I would imagine, would have watched the situation with France very closely and seen the backlash to imports of popular French goods into the US. I guess helps to justify why it wasn't part of the main budget announcement. It was kind of hidden away in the annexes. I think actually, in reality, what will happen it may take slightly longer than a year, but there will be some kind of global consensus, and we will see this tax disappear. So I think it's very much a short-term tax, a short-term way of raising revenue. I don't think it will raise significant revenues, given that the group that it currently targets is very small. But you're right in saying that it may be used in some way as a bargaining chip to agree a better trade deal with the US, particularly given the situation that happened with France and the threat of excessive tariffs on wine and cheese going into the US. But it'll be interesting to see what happens with that.
Oh, thank you ever so much, Neve. Well, I think that brings our Q&A time to a close, and we're exactly on 5 o'clock. Amazing, given that it was me doing some of the talking. I do tend to ramble on. So thank you ever so much, Mark, for being our guest today. And let me hand back to Helen just with some closing remarks.
Thank you both very much. That was really great, some really insightful information there. I'm sure that the attendees were scribbling away plenty of notes. If there is anything that you want to refer back to, as I say, the recording will be hosted on the website, so please do share with your colleagues. And on your screen now, you will see the upcoming Chamber events. So lots in the calendar. We've now launched, obviously this is part of a webinar series, and we also have a podcast as well. So all of those can be found on the Chamber website. Important to highlight is the 29th of October Annual Business Awards, a flagship event in the Chamber's calendar, hoping to be delivered at the Shangri-La this year. And just there in the white boxes, you can see some of the categories that are open for entry. Entries will close on the 5th of June, so please do get in touch or visit the website if you'd like further information. You'll also receive an email following this, just asking for your opinions on today's webinar. Please do give us any feedback that you have. We're open to learning from our webinar experience, and if you'd like to be put in touch with either Mark or Martin, please do let me know. And finally, a thank you to Select Investors for supporting us on this event and the series itself. So thank you very much for joining us, everybody, and hope to see you soon.